Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. Big thanks to Josh Schaefer for holding the fort last week. It's Monday, 21st July. Coming up on the show, Commerce Secretary Howard Lutnick says that August 1st is a hard deadline for countries to begin paying tariffs to the US. We'll tell you how the markets are taking the latest trade pronouncement from the Trump administration. Also, we'll have the answer to who stopped the president from firing the chair of the Fed, Jerome Powell. And find out about Boeing's biggest customer in Europe, Ryanair, and how its latest financial report is looking. So, grab your coffee and let's own the morning. Now, before we delve into the three things you need to know before the opening bell rings, let's have a quick check of where we stand in the futures market. And it is green across the board. Stocks look like they're poised to build on last week's record-setting rally in growth names. Now, remember, markets are entering a critical week, defined not just by mega-cap earnings, but the continued risks surrounding President Trump's looming tariffs. And that brings us on to our first thing you need to know before that bell rings, and that was Commerce Secretary Howard Lutnick reaffirming on Sunday that the White House's August 1st deadline for new tariffs was a hard stop. However, he then did go on to say that he's looking at continued conversation beyond that date and that smaller countries would have a baseline tariff of 10%. That could bring some relief to them, as the president suggested recently that that figure could actually have been a bit higher. But the big trade deal that has yet to be done is with the European Union. The bloc of 27 countries thought it was on the verge of a deal. But according to the Wall Street Journal, it's getting ready for a counterattack. The report says that the Trump administration is pushing for a baseline tariff on most European goods of 15% or higher. And that's come as a bit of a surprise to EU officials who are expecting a 10% levy. Now, the Wall Street Journal goes on to say that the EU is considering countermeasures, including restrictions on US digital services and access to public procurement markets, but only if a deal is not reached. Now, the second thing you need to know before the opening bell is who was responsible for persuading the president not to fire Jay Powell. Well, according to the Wall Street Journal, it was the president's Treasury Secretary, Scott Bessent. But the president denied the report. On Truth Social post, he labelled the story typically untruthful. But according to the report, Bessent told the president that removing Powell before his term is up next spring could spur a negative reaction in the economy and the markets and push the Federal Reserve into uncharted legal and political territory. Now, the report went on to say that he also argued that the US Central Bank looks poised to cut rates, so removing the Fed chair would be unnecessary. But Trump went on to say on Truth Social that he knew what was good for the markets and that, quote, "People don't explain to me, I explain to them." And the last thing you need to know before the bell rings brings us back to tariffs. We're talking autos and Stellantis. The giant car maker expects to swing to a net loss of $2.7 billion for the first half of the year. The owner of brands that include Chrysler, Dodge and Ram said it expected to take a hit from restructuring costs and also the initial impact of tariffs. It said that its initial estimate was that tariffs imposed by Washington on US imports would have costed around $350 million due to lower shipment and production cuts as the company adjusted to manufacturing levels to the trade duties. Now, it's worth noting that last year, Stellantis imported more than 40% of the 1.2 million vehicles it sold in the US, mostly from Canada and Mexico. And in April, it said it had reduced vehicle imports in response to tariffs. Now, Antonio Filosa, the firm's CEO, has only been at the helm around a month. He's taken over from Carlos Tavares, who angered dealers and unions with a series of cost cuts. It's clear that Stellantis' issues are at their worst in North America, where shipments fell 25% in the second quarter. Now, Stellantis shares, you can see there, fell in early trade in Milan by around 2%. Its US traded listed shares are also pointing to a similar slow start on Wall Street. In fact, shares are down around 30% this year so far. But Stellantis isn't the only car company reporting this week. Tesla are up on Wednesday, and RBC Capital Markets auto analyst Tom Narayan spoke to my colleague Josh Lipton on what to expect from the EV maker.
I think the expectations on the sell side numbers are pretty low. The margin number is not that much better than the first quarter, and the deliveries were a lot higher. I know the energy storage number wasn't that great, but they're going to get regulatory credits. I think there's a good chance that they'll beat. But investors I'm speaking with are already positioning. That's why the stock, I think, was up today. So, when it reports, we'll see. The other thing to keep in mind is what always drives the stock on earnings is the conference call. Commentary on the call, on robotaxi, on this affordable car. These really will probably drive the stock more than just the print.
What do you think Musk is going to say about China on the call and how that business is going?
Yeah, that's a big topic. I actually think that they're pretty optimistic there. The China situation is more because EVs are selling like crazy. The big losers there are more about companies selling ICEs there, right? The German OEMs are really losing share. Tesla's actually doing all right. I think it'll be pretty constructive, pretty positive there. The worry is really more about Volkswagen. Those types of cars are losing share, not really Tesla.
Now we're looking at some key market movers this morning. Verizon and Ryanair ahead of that opening bell. First up, Dow component Verizon out with second quarters in just a little while ago. The US's largest mobile service provider reporting over $34.5 billion in revenue versus $33.8 billion expected. An adjusted earnings per share of $1.22 versus $1.19 expected. Now, outlook to a 1 to 3% gain, up from a 0 to 3% gain. Verizon had a disappointing start to the year, but was expected to add a modest number of new subscribers, boosted by a promotional campaign. The carrier launched, which included a 3-year price guarantee and free phone trade-in. Verizon and other major wireless carriers are expected to see increased cash flow as a result of President Trump's new tax policies. Now, next up, it's Ryanair. It's rising after reporting its net income in the first quarter more than doubled. The budget airline saying it will recover almost all of last year's 7% full-year fare decline, which could lead to reasonable net profit growth in fiscal 2026. Second quarter fare increases will be lower than the first quarter. Profit after tax in the first quarter handily beat expectations, while revenue rose 20% from the prior year. Now, Ryanair says fiscal 2026 traffic remains on track to grow just 3% due to delayed Boeing deliveries. Now, Ryanair is Boeing's biggest European customer. The Irish carrier said that any tariff cost would be on Boeing to bear. Ryanair expects Boeing to deliver planes it has ordered at an agreed fixed price. Now, here's some analyst commentary for you. JP Morgan sees a strong outlook for the summer travel season, and RBC likes the long-term outlook for the airline due to its low costs and profit margins. Now, coming up, a clip from Yahoo Finance interview with Chicago Fed President Austin Goolsbee. So stay tuned as we head to the break. Welcome back to Market Sunrise. Chicago Fed President Austin Goolsbee, he joined Fed correspondent Jennifer Schoenberger on Market Domination to discuss how tariffs impact his outlook for inflation and what he wants to see from the US economy in order to cut rates. Well, let's have a listen.
That's the dual problem is if we're making these announcements in a kind of a drip fashion, you can't just count on the, let's call it the economic theory of tariffs. Hey, it's a one-time increase in the price level. That's a transitory inflation shock that a central bank doesn't have to worry about. You can't really make that argument if it's not a one-time increase in the price level. That said, as I've been emphasizing, imported goods, which these tariff taxes apply to, are only 11% of GDP. So there is a sense in which if it will stay in the 11% lane, it doesn't have to have a big material impact on inflation overall. And there, what you're going to be nervous about are if the tariff announcements lead people to freak out and change their behavior, that jumps it out of its 11% lane. If you start applying them more and more to intermediate goods like parts and supplies and components, then it's raising domestic costs of production and it gets out of the 11% lane. Or if there's big retaliation, then again, it's getting out of its lane. We were getting some relief on all three of those fronts as we got some exceptions and where they were backing down and doing the negotiations. And I think we just have to hope that we back down on all three of those fronts again, because right now we're kind of ramping up on all three.
Yeah, Austin, you had said that the central bank could cut rates if we saw what you called, quote unquote, dirt come out of the air. Now that we're seeing more uncertainty and an increase perhaps on these tariff rates, is this more dirt, or if you will, mud being slung? Does this prolong the timetable to wait and see what to do with interest rates? Has this changed your timetable at all on interest rates and cutting rates?
I feel like it started as dust in the air, moved to dirt in the air. Now I'm going to have to start thinking about, is there such a thing as mud in the air, or if the mud is in the air as it is getting on us? I think anything that makes it harder to figure out if we are on a path back to 2% inflation, anything like that is extending the timetable of when the rate cuts can happen. As you said, I have been of the view that before April 2nd, before Liberation Day, the dual mandate grounds of the Fed of just price stability and maximizing employment were looking pretty good. And it looked to me like we could afford to start cutting rates, and that rates, I was saying then 12 to 18 months from then could be a fair bit below where they were. Now, it's been 3-4 months, so now maybe we're 9 to 15 months away. I still think if we can get that uncertainty out of there and we aren't off the path, if we are still on the way to 2% inflation, rates can come down. But we don't know if we're on the path to 2% inflation because we don't know on tariffs, on energy prices and geopolitics, and in a few different areas. We don't know until we know. We're going to have to wait and see what's happening in the data. If we get multiple more months of benign readings on inflation, I would be feeling more comfortable. If we start to see a ramp up on prices coupled with a ramp up and increasing the tariff rates, then we're going to just have to see how big an impact that has.
Given where we stand right now, though, Austin, do you still think that rate cuts are on the table in maybe the fall months of this year? Or are you looking more in sort of a hold pattern right now?
Well, Jen, I always say, I don't like tying our hands ahead of the meetings. I want to hear what my colleagues around the table have to say. I want to see all the data that come in between now and then. But it's the biggest table literally I've ever seen in my life there. You've seen it. And so everything is always on the table. I have no problem. And as I say, if we can get the dirt out of the air and it shows we're still on path back to 2% inflation, then I think for sure it's realistic that rates could come down. It's just that if it gets cloudier and cloudier, so you can't tell whether you're on that 2% rate, that's to me is a recipe for waiting.
Fantastic interview there from Jennifer Schoenberger. Well, it's time for another break, but stay locked into Market Sunrise to find out what today's trending tickers are. We'll be right back. Welcome back. Now it's time for trending tickers. We're watching Domino's, Cleveland Cliffs and Block. First up, Domino's. It's rising on its second quarter earnings report. The pizza chain reported $1.15 billion in revenue, in line with expectations. Adjusted earnings per share clocking in at $3.81, missing expectations of $3.95. US same-store sales grew 3.4% in Q2 from the prior year, beating expectations of 2.18% growth. International sales also grew, with the company's CEO saying the chain continued to grow abroad despite macro challenges. In the US, both delivery and carryout grew. The CEO says the company is well positioned, citing big advertising budget and its rewards program. The majority of Wall Street analysts are bullish on the stocks. Now, next up, another earnings mover, Cleveland-Cliffs. It's reporting $4.93 billion in revenue versus $4.88 billion estimated, also seeing an adjusted loss per share of 50 cents versus a loss of 79 cents a share, which was estimated. The company's capex spending is also reported to be around $600 million. That's below estimates. Now, the majority of Wall Street analysts have a hold rating on the stock. And finally, shares of Block are rallying as the stock is set to replace Hess in the S&P 500 index this week. The move follows Chevron's $53 billion acquisition of Hess. The changes in the index will go into effect prior to the start of trading on July 23rd. That's Wednesday. This could be a big deal for Block, as index funds, many of which track the S&P 500, will now buy millions of Block shares. A JP Morgan analyst is estimating over 54 million shares could be scooped up by indexes. The firm raising its price target to $90 a share, implying nearly 24% upside. Now, next up, we have our call of the day and another tech bubble. Could it be similar to the dot-com bubble that we saw in the late 90s? Well, that's our question of the day. Executive editor Brian Sozzi presents that question of the day to our panel, beginning with Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors.
I do think that we'll have a lot of growth, but it looks somewhat extreme to me that the valuations for those significant big stocks in the S&P 500, which make up such a big share of the overall S&P 500, is at these very high levels relative to where we were in the IT bubble, where the valuations of the 10 biggest companies in the S&P was a lot lower. So I do think that there is a bubble from a PE ratio perspective, because these companies have just become so expensive and it's become so concentrated for investors that it's really no longer a diversified investment to buy the S&P 500.
All right, still with me is my roundtable, Chad Morganlander of Washington Crossing Advisors, and Yahoo Finance senior reporters Ali Canal and Inez Ferre. Chad, over to you on this one. You never know if you're in a bubble until after the fact, right?
Yeah, correct. And in fact, your clip there was correct. You are sitting at a 23 multiple, so you are in the earlier stages of a bubble. Living through the 90s, one must recall that the S&P earnings or PE multiple got over 30 times in 1999. So there will be, when you look back at this time, there will be a lot of malinvestment made, some silly investment ideas that didn't work out. But over the long run, over the next 10 to 15 years, this excitement about artificial intelligence is justified. It's just a matter of the valuation gap and where that valuation gap meets the reality of earnings.
Well, it sounds like, Chad, if you want to compare it to the internet craze, we still have more to go in terms of valuations, at least from a PE perspective.
Well, that could be true. Again, buyer beware on the type of companies that you're buying. At Washington Crossing Advisors, we own Alphabet, for example. That's trading at roughly about a 17 times multiple when you take away cash. Well, full disclosure, not only do we own it in our portfolio, but I personally own it. But that company has a full competitive stack to go against OpenAI.
Inez, I haven't covered a good bubble in a while. The last one I covered was cannabis a couple of years ago. Every day, cannabis stocks would go up until, well, they did it. And maybe it's time we do get a bubble bursting, and maybe it does start with AI.
And we could, for sure. This is probably different than cannabis because it is touching all sorts of industries. I mean, if you take a look right now at the different sectors of the S&P 500, you are seeing industrials, which is leading the way. Think big construction, factories, AI centers. You are seeing tech. You are seeing utilities, which is usually the sleepy part of the market. Utilities is up, outperforming the broader market. And then, of course, you're seeing financials as well. So you can tell that it is touching all parts of the market right now. And if you think in the future, like what Chad was saying earlier, look, long term, this will be a huge productivity boom for the entire economy. Because just imagine having endless amounts of workers at your disposal, endless amount of AI bots that are doing work for you. And this is not just about AI bots, then you're talking about later on having robots doing everything. I mean, this is going to be a massive, massive productivity boom. But yes, we could be in a bubble right now. We would see it deflate, but then we would see exponential growth.
Interesting stuff there from Brian Sozzi and his guests. Now, before we go, let's check in on the markets. We'll start with the US futures, and you can see a sea of green there. And basically, the markets, it's a critical week, as I said earlier. They're all looking out for what news could come out of the Trump administration on tariffs. But also, there's some key earnings. We mentioned Tesla, but don't forget, on Wednesday, we also get Google parent Alphabet's results out as well. That'll be closely watched too. Well, let's see how the tariff noise is affecting the markets in Europe now, and have a quick look at the European markets. They're down a little bit, but you'd expect a bit more than that actually. So maybe they are kind of shrugging off the tariff noise, but they are still down. You know, the CAC on down there the most, about 0.4%. Now, on Friday, remember, the Genius Bill was finally signed by President Trump, and look at the impact that's having on cryptocurrencies. Bitcoin there up, Ethereum up, Solana up, Ripple up, everything up. Also, keep an eye on some of the shares related to crypto as well. They're also trading higher in the pre-market too. The looser regulation is something that the crypto world have been calling for, and they see this as a big win. Now, finally, we'll have a quick look at gold as well. Now, perhaps there is a bit of nervousness, though, here about tariffs. Gold there up around 0.6%. So the stock markets may be a bit more relaxed about tariffs and the noise coming out of the Trump administration. But, you know, there is still some flight to quality there, with gold up around 0.6% there. So we'll keep an eye on gold, keep an eye also on all the other precious metals as well. Really worth keeping an eye on gold, though, in particular. Now, that's Market Sunrise for this morning. I'm afraid that's all the time we have for you. Let's stay, but you should stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.